Welcome to the Jill on Money Show. It is Friday, September 20th, and we are here trying to take the mystery out of your financial life. We do that by answering your questions. If you have one, go to our website, jillonmoney.com, and click the Contact Us button. If you'd like to join us on the air live, check the box and Mark will do everything else. You can also sign up for the free weekly newsletter, which comes out every Friday. Mark does such a fantastic job in compiling the stories you may have missed. And if you are not a member of Jill on Money Live, here's your chance, because next week we have a big webinar coming up. So you've got to be a member of Jill on Money Live. And that is a cost of $35. I think it's pretty reasonable. And for $35, what you will get is access to 4 live webinars over the next 12 months, the back catalog of webinars, as well as all of the video content that's up there. So you might want to check that out. So the next webinar is on next Tuesday, September 24th, 7 p.m. Eastern Time. We've got such a great lineup because we want to take a deep dive into the real estate market in light of the Federal Reserve's actions, also in light of those new rules that the National Association of Realtors have to put into place about fees. So we've got 2 great guests. We've got a mortgage broker, we've got a realtor, and we're going to talk real estate next week at the webinar. Again, you've got to be a member of Jill on Money Live, a subscription service, and $35. It's all yours. Okay, so let's talk a little bit more about the Federal Reserve meeting, what the central bank did, why they did it. I know I talked a little bit about this yesterday, but let's start by airing the segment that I conducted on CBS Mornings yesterday. The anchors yesterday were Gayle King, Vladimir Duthiers, and Tony Dokoupil. So here's the segment about the outcome of the Federal Reserve meeting.
CBS News business analyst Jill Schlesinger is here to tell us what this means in normal people terms, you could say. Good morning to you, Jill. We've been hearing about this for a while. Half a point, people say, that doesn't sound like very much, but it's still bigger than what many thought.
Yeah, we were looking at maybe 1/4 of a percentage point. We got 1/2 of a percentage point. And what's interesting about this is it's a recognition by the Federal Reserve that after fighting inflation for the last few years, it now needs to turn its attention to the rest of the economy. Fed's got 2 main jobs: make sure the economy is strong enough to create enough jobs for anyone who wants one, and also control prices. With inflation coming down, the Fed now says, okay, we got to concentrate on the economy, dropping rates. They're likely to do another 1/2 of a percentage point in total by the end of the year, and then get to about a 3% federal funds rate over the course of the next 2 years. But it will happen gradually. It's not going to happen all at once.
But what does it mean, though? How are we going to see the difference? If you're walking around the world.
The way you're going to see it is you'll see interest rates overall start to come down. So it means that when you're borrowing money, maybe to buy a new car, maybe to finance that credit card bill that you have, you'll start to see interest rates slowly go down. So if you're paying down that credit card balance, you're going to get a chance to pay it down at a lower interest rate. If you're going to buy a new or used car, those interest rates should come down. If you're going to get a new mortgage or refinance, those rates are not directly controlled by the Federal Reserve, but they've already started to come down. So if you're a borrower, rates come down. If you're a saver, rates come down. Not such good news.
But, Jill, part of the reason people have big credit card bills is because prices are still high. I was just in Georgia shooting a story in Peach in Forsyth County, and people complain about prices constantly. They are still high, right? That's true.
Absolutely. This is a huge point of confusion, and I get it. You say, well, wait a minute. The inflation rate's coming down. That's what Fed Chair Powell said, but prices are still high. That's because the rate of increase of prices is coming down, but prices overall, they're still high. Remember, we always have inflation in a growing economy. Usually we have inflation of about 2%, but we saw inflation spike up to 7%. That big spike pushed all prices up. So even though they're not going up by that much, they're still a lot higher than they were 5 years ago, 20% higher or so.
So what needs to happen so people can say, okay, prices are coming down? We know gas is coming down.
Yeah.
What needs to happen?
What needs to happen is our wages start to go up faster than the inflation rate. And over time, if your wages are going up and the inflation rate is going up by here and your inflation rate's here, you'll feel better at the end of the day. It will take some time, and I bet about another few years before we put this period behind us.
Ooh. Okay, so I covered a lot of ground in that segment, but I want to get down to some of the things you should really be thinking about as we are in this transition period. First of all, as I said, rates are going to stay high for a while. And that means that you really got to try to whittle down those outstanding credit card balances if you can afford to do so. Now, as always, the best way to do that, automatically direct a little extra money towards that balance. It's so much easier when it's automatic. Now, if you are a saver, we've talked about this a lot on this program. You probably want to start to lock in the still high CD rates for any upcoming expenses that are occurring within the next year or two. So I'm talking about maybe a tax bill next April. Maybe it's a future tuition payment. Maybe it's a car purchase that you're thinking about making. I'd lock those savings rates in because they're going to go down. I think there's also a lot of speculation about what the change in interest rates means for the economy and for stock markets. And, look, let's talk about the economy in the big picture. It is clear that Chairman Powell does not think that we are seeing any signs of a recession on the horizon. He actually even said, here's the direct quote, "I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated." So, he's pointing to solid economic growth. He's pointing to inflation coming down. And, I think that he also speaks to some of the concerns of regular people when he understands that prices are still high. I think that the question of what to look for if there is going to be a recession is weakness in the job market. And we already know that we're slowing down, but, we know that also if we see job losses or wages starting to moderate or stagnate, that's going to be really hard on lower income households. Already late payments are increasing on credit cards and auto loans, but, so far little cracks that we see, they're not spreading into some broad weakness into household spending. And, the other part of this is that this economic soft landing, which we've been talking about for so long, I think the Fed may have lucked its way into it. They got started too late in raising interest rates. But once they did it, they got going fast. They raised those rates. I think they probably waited a little bit too long to start cutting interest rates, but here we are. And, mortgage rates, they're already down more than 0.5% over the last 6 weeks or so. We're at the lowest level in over a year in mortgage rates. I think that rates will continue to soften, but it's not going to be a 3% mortgage rate that you're going to get. It's not going back to that level. And that is important. So if you're waiting to buy or list your house, hoping that you're going to see a 3% 30-year fixed, don't wait, because that's not going to happen. Do give us a holler. Get on the horn with us. Go to JillOnMoney.com, click the Contact Us button, and write us a note. And if you're really contemplating a big shift that might be interest rate sensitive, then that's even more important to talk through, because I don't want people trying to time the housing or the mortgage or the investment markets. These are all long-term decisions. So instead of making your short-term brain lead the way, let our long-term brains help guide you along your way. I think that would be really helpful for you. Okay, that is it. That is the program. It's Friday. We like to do some business. Our music is composed by Joel Goodman. Mark Talercio is our executive producer and king of all things web. We are distributed by Odyssey. And by the way, you can subscribe to us on the Odyssey app or wherever you find your favorite podcast. Please lift someone up. Change your work, change your wealth, change your life. Thank you for listening, and we'll talk to you tomorrow.